G'day, welcome to Ask Alan for this week, and it's great to see you. Thanks for joining me. Well, it's all happening at the moment, isn't it? What we've got at the moment is bond yields rising. So the question is the bond bull market over? I don't think so, but I'll examine it in more detail on Saturday in the briefing, along with a bunch of other stuff. So anyway, remember the live stream today is general advice, may not be appropriate for you, so please bear that in mind. And if you've got any questions as we're going along, please feel free to pop them in and I'll get straight to them. So let's get stuck into it. Andrew says, could we have an update on electro-optical systems, laser-based armaments? I bought a swag some years ago, 73 cents, when you interviewed the CEO. Shares are on a rocket following their latest profit announcement. They've gone from eating cash at a massive rate to generating it even faster and are now pushing $6 a share. So they have been a great stock, no doubt about it. And I think I was pretty positive on them when I interviewed them. Could we get an interview with the CEO again and get a feel for how well they're making the transition from startup to major manufacturer? In the current macro environment, they seem like a company with great upside. Well, they do, indeed, they do. All right, they're on the list. Greg, put them on the list. EOS, Electrical I can't even remember the bloke's name. But yes, very definitely we'll get to them at $6 a share, heavens above. That's been great. Tim says, hi, Alan. Quick question on deciding between an LIC and a fund of the same manager, e.g. Magellan Global Fund MGE, or investing in the actual fund itself. Now, obviously, both represent the same holdings. However, I was looking to dollar cost average. Would it make more sense to invest in the fund directly, given they probably receive wholesale rates? Meanwhile, if I was to buy directly from CommSec, I would pay the regular $29. If I did two $1,000 trades a month, then it builds up in the long term as it's still to 2.9%, as opposed to maybe $5. Yes, well, of course, if it's $5, it depends on what it depends on the price. Well, I think the main thing you'd have to watch, Tim, would be the minimum investment. I mean, if the minimum investment is $1,000, then you're fine. But if a lot of these funds, wholesale funds, or at least retail funds that are unlisted, have a minimum investment of $10,000 or something like that, so you might find that you can't really do dollar cost averaging with that. But you're right. You're absolutely right to pay attention to the transaction cost, because that's where dollar cost averaging can bring you undone. Absolutely. The $29 is not the cheapest in the market, so you might want to think about changing brokers. You can get $15. I can't remember who it was with now, but there are cheaper brokers, and obviously they perform the same service. You're not relying on them to stay solvent, particularly. I mean, you're not investing with CommSec or the other broker. So just keep an eye on that. You might be able to get better than that. I think the last time I looked, in fact, the cheapest broker in the market was Self Wealth, which I think was $9.50 per trade at the time. So look, you can certainly do better than $29. CommSec is possibly the most expensive in the market. But you're absolutely right that the killer with dollar cost averaging is the transaction cost, which, as you point out, could be 3% each time you do it. In which case, you're really hampering your investing. Look, if you can dollar cost average through a fund that has no entry fees and zero cost to buy, maybe $5 instead of $29, then you're obviously better off doing that. It just depends on the actual conditions of each of the funds. Dollar cost averaging generally works better with a listed security, but the problem is the transaction cost. So it's probably best to do it less frequently in bigger lumps, so the percentage of the transaction is lower. So maybe once a quarter instead of twice a month. Investing. You still get the benefit of the dollar cost averaging if you're investing, say, $6,000 a quarter instead of $1,000 every fortnight. Chris says, "Hi Alan, excellent audios. I know you can't give personal advice, but my partner wants to put some money into REITs. Would this be a good idea with a world that is going slightly bonkers?" Well, as you say, this is not personal advice. In general, I reckon you've got to be careful of REITs at the moment because they tend to be, obviously the valuation is influenced by long-term interest rates, bond yields, both for the reason of discounting future cash flows back to the present, but also comparing their yield with the bond rate. If the bond rate goes up, bond yield goes up, that would tend to depress the valuation of the REIT. It depends on. I mean, I don't think that we're going to see a big increase in bond rates at the moment. That we've seen a bit of an increase in the past week or two. The Australian 10-year bond rate has gone from 0.9 to 1.2, so up 300, up 30 basis points. So look, I don't really know where that's going. At some point, interest rates are going to rise, at which point REITs will decline in value, that's for sure. The other thing to be careful of is the question is what they actually own, because a lot of the REITs are retail REITs, shopping centres and so on, and a lot of shopping centres are in strife. I was out, but the thing is, they're not all the shopping centres are in trouble. For example, I was out at Chadstone on Sunday. I could barely move. It was unbelievable. The place, and as I was leaving at lunchtime from Chatty. There was this massive queue of cars to get in. So there's REITs and REITs. There's Vicinity Centres owns part of Chadstone. I mean, that's clearly going to be okay, or at least for a while at least. Chadstone Shopping Centre is fine. But a lot of regional centres, which some of the REITs own, are perhaps not going to be fine. So you just need to be careful which REITs you buy into. Also, you need to make an assessment of whether it's office or industrial, where the things are, and so on. So you have a look at what they own, and make an assessment of whether you think those assets are any good or not. And just bearing in mind that the overlay of interest rates, low interest rates, which have been benefiting the valuation of REITs, is likely to come to an end at some point. We just don't know when. Andy says, on a previous episode, you had disdain for CFDs, and I can understand this. I don't know about disdain. I mean, I was saying that CFDs are, on the whole, gambling, because you're just betting on on the contract for a difference. You're not actually investing in an asset. But anyway, leaving that aside, I have a fairly significant portfolio for a sole investor. I do have some funds put away in one of the CFD platforms as a hedge against the markets falling. I use it very infrequently and only for covering the indices. This may sound simplistic and inefficient, and an inefficient way to hedge against a substantial market fall and keep my portfolio intact. I have a cash stash, so I'm not looking to panic sell, but I do believe in insurance against a fall. I do too, Andy, and I think that it's a good idea to take out insurance if you're concerned. And CFDs are one way to do it. So, as a hedge, I've got no problem with short selling a CFD. It just leaves you a little bit exposed. That's all. Because you are gambling. It's still gambling. Another way to take out insurance is options, either put options, in particular a put option. But that's up to you, really. You could take out put options over individual stocks, as well as the index, I think, and they don't leave you quite as exposed as a CFD contract. Matt says, "Hi Alan, I've got a question about growth investing in the current environment. You have mentioned recently that it may not be the best time to invest in growth and cash-burning stocks. I'm wondering why this is the case. I would think companies with good products or services that are growing fast are always worth investing in." You're absolutely right, Matt. Of course, that's true. High-growth companies that have good products, good businesses, that's fine. Of course, always the case. there is a difference between a growth stock and a cash burner. Obviously, a cash burner would generally be defined as a growth stock, but there's a lot of companies that are not burning cash, that are making money, that are regarded as growth stocks simply because they've got a high PE. So I think when the simplistic definition of a growth stock versus a value stock is a high PE price earnings ratio versus a low PE. And the fact is that over the past few years, about 2 or 3 years, growth stocks, high PE stocks, have outperformed value stocks, low PE stocks. It's partly because with low interest rates, future cash flows are worth more than present cash flows. So really, when you get down to it, to some extent, a value stock is valued and valued in the broader sense for its present cash flows. Growth stocks are all about the future. Investors are buying them at 50 times PE because they believe in the future, they believe in their future cash flows. And future cash flows, when interest rates are low, future cash flows are worth more than, in some ways, worth more than present cash flows, simply because of the way the discount rate works. The lower the discount rate, the higher the present value of future cash flows. So that's one of the reasons growth stocks have been outperformed, but also it's just simply that there's a lot of excitement around a lot of these technology stocks that are inherently growth high PE stocks. So that simply has led to a bit of a kind of a rebirth of the dot-com bubble in a way, that a lot of these stocks have been really highly valued. In America, they're called the FANGs, Facebook, Apple, Amazon, Netflix and Google. In Australia, it's the WACs. So WiseTech, Altium, I can't remember them all now, not Atlassian, but and Xero. There's 3 A's in the middle there, W, 3 A's and the X. I can't remember all the A's, but they're all kind of technology stocks that are highly valued. They have been driving the growth area of the market higher. The problem with cash burners, which is kind of distinct from growth stocks, is the need to get through the valley of death, which we've been writing about in the briefing, which is getting to break even, cash break even. The cash burner's fine if they've got a good product, and most importantly, they've got plenty of cash in the bank, or at least access to cash. The difficulty is that a lot of these companies, cash burners that haven't got much money in the bank, they can't make it, because even if they've got a good product, they need a couple of years to get it to cash break even, and nobody will give them the money. Uber, for example, is a big cash burning stock. It's burning colossal amounts of money, but it's got so much money in the bank, it's probably okay. And that goes for Xero as well. I don't know how much money Xero's got in the bank, but it's still burning cash, even though it's capitalised at 8 or 9 billion, or maybe even 10 billion now. But even if it hasn't got that much money in the bank, it's got access to tons of it, so it's fine as well, no problem. The problem is for companies that have got a low share price, falling share price, and difficulty getting cash to make it to cash break even, and still burning a fair bit trying to get there. So that's the problem with cash burners. You've got to really watch them, and only invest in ones that have got enough cash in the bank, if you can, to make it, or at least have access to cash. Growth stocks, there's a bit of a debate going on at the moment as to whether growth stocks have had their day and its values turn. I think maybe not. I mean, I think that we're still in. I think we're for a while yet in a growth investing era, and value investors are still going to struggle for a little while. Lisa says, "Hi Alan, thanks for your info regarding the Macquarie Bank SPP share purchase plan last week. Just wondering, why do companies in general offer an SPP?" Well, I think a lot of the time Stephen Mayne shames them into it. He writes to them all the time and tells them to have SPPs, because a lot of companies would prefer to just do sweetheart deals with with institutions, do a placement for the money because it's easier, that costs less, they don't have to worry about going to the market and so on. But it's not fair on shareholders because usually they're giving these institutions a discount on the share price. And leaving aside Stephen Mayne shaming them into it, I think a lot of the time they are conscious of the fact that a very large proportion of their share registers these days are owned by self-managed super funds. And so they've got to really be careful about pissing them off, because they've become self-managed super funds are still growing quickly, and they've got to be careful to make sure they look after them. And the SPPs are a way of looking after them. They're raising money, they do a placement, and at the same time, at the same price, they do an SPP, which allows shareholders, Macquarie or Transurban, to buy $10,000 or $15,000 worth of shares at the same discount. And I think it's a good idea. It's a good thing they're doing. A lot of companies do it for the purpose of keeping in sweet with their SMSF shareholders, and also to keep Stephen Mayne off their back. Jesse says, "G'day, Alan. My question is regarding GenX Power, GNX. You interviewed them twice, and they've since confirmed NAIF. I'm not quite sure what that means. And state funding for their pet project, the Kingston Hydro project. There's only really been positive news flow since your first interview in June 2018, and the share price hasn't budged since. There has been some dilution from equity raisings and cash flow from the hydro project is some years away, so it's a long-term prospect, but I'm somewhat surprised there hasn't been any share price appreciation for more than over a year. If you were to enter at these levels and hold long-term, it would be paying a solid yield, something very sought after from the investment community these days. What are your thoughts?" You're absolutely right, Jesse. It's a long-term investment, and it's a classic case of this, the market being worried about stocks that have to raise capital to keep going and to get to break even. Now, I agree with you. I think that their project is a good idea. I think it's undoubtedly going to work as long as they get to build it. Now, so where are GNX? I can't remember what their... so share price is 25 cents. As you say, it's been at that level for a while now, a couple of years. Well, it's been gradually trending down. I'm not quite sure what their cash situation is, but I should interview them again soon. The capitalisation is 100 million. Have they got access to cash? Maybe. I mean, the problem is the share price, and this is the common thing, right? Share price has been falling gradually over 2 years. Peaked at 39 cents in late 2017. Now 25 cents. The trouble is that as they need capital, the lower the share price goes, the more dilution there is. They don't want to do that, but gradually they have to. And as I say, I don't know quite what their cash situation is. I probably can't call it up while I'm talking to you. But they need to, obviously they need to make it. They need to get through the valley of death. Which is not that simple. And I suppose the market's a bit worried about that. But look, I agree with you. I think it's a good prospect over the long term, and I might get them back on to talk to them about it. They do make money. They're not as if they're completely without any cash flow. The net revenue of 15 million in the year to June, EBITDA of 5.5, net profit after tax minus 5.5, cash at bank 3.4. So they got a placement in June of $21.5 million. So they've got a fair bit of cash there. They should be right for a while. As to whether it gets them to break even, I'm not sure, but maybe we should get them back on, Simon Kitson back on. But look, the trouble is there's so many companies to interview. I can't keep interviewing the same ones, much as I'd like to, just to make sure we keep on top of them. But look, we'll put them on the list. We'll probably get to them in a month or two. But we have plenty of people to interview, plenty of prospects ahead. And that was the last interview, the last question. So thanks for joining me today. It's been great talking to you. We'll see you next week. And remember, this live stream and the answers were general advice only and may not be appropriate for you. And I'll see you next week. Thanks.